Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1442A, and today's date is December 7th, 2017, and the title of the episode is The Indicator That Predicted the Bear Market 100% of the Time Just Hit Again. Let's get into the economic collapse financial news. Now, we talked about how the banking system, the central banks, they are creating the future market for Bitcoin. And we talked about how they're going to use this to try to control the crypto market. This is what they're using it for, just like they use futures and derivatives to control the gold market, the stock market, and pretty much everything. And right now, the world's largest banks, they're pushing back on the introduction of Bitcoin futures. They're concerned with U.S. regulators that the financial system is ill-prepared for the launch. Now, what they're really saying is they're very worried about the volatility of Bitcoin. Remember, they like to do things when they have control or somewhat control over it, and then they add more control on top of that. Since the crypto market is decentralized, since it is issued not just in one area, it's issued in many different areas, which they have no control over whatsoever. They don't understand, or they're very worried of how they're going to control the entire market. And a couple of the banks, like Citibank, Bank of America, and others, they're saying that, yeah, we're not going to offer, any type of clearing for these type of futures. We're not going to do it. Goldman Sachs, on the other hand, said, listen, they will allow the futures to be cleared through them. And we'll have to see how this all plays out, because we can see right now the banks that are very, very worried about this is, of course, JP Morgan, because they know that they can manipulate, they can control, and if they don't have control, they're going to lose out. Think about all these banks, all their investments and everything they've been doing. They've been just continually making more and more money as time goes on from everything that they can control. When you throw in Bitcoin and the central bankers want to control this, they're a little bit nervous about this. I mean, Citibank, Bank of America, Morgan Stanley, they're all worried about this, and they're all worried about, what happens if it gets out of control. We're going to lose. And this is their biggest worry right now. So we'll have to see how this plays out, and we can see right now the central bankers are definitely making their move to try to control the crypto market right now. Bloomberg put out a very interesting story where they're saying that unemployed Americans are the most comfortable in 16 years. And when we look at this, you have to scratch your head. Well, what does this even mean? I mean, is this a good thing? Because if you're unemployed, it means you're not making any money. Even if you're getting some type of assistance through the government, you're still really making not much money whatsoever. And there's a lot of people who are unemployed. Now, is Bloomberg coming out with this story saying that, yeah, there's a lot of people out there that don't have jobs, but they're okay with it? I think it's the opposite. I think people are not okay with it. I think people are looking for jobs. I think people want jobs. I think people want to pay their bills. I think people want a better life. I think people want to do all of this, and you can't pretty much do it here in the U.S. Things have changed dramatically. There's a lot of individuals, especially those people in retail, those people in corporations, who have lost their jobs. GE right now across the world, they're going to be slashing about 12,000 jobs. And we see right now this is going to affect individuals in the professional area and some in research and development. And this is 12,000 jobs that are going to be lost. And you're going to see a lot more corporations say that they're laying off people, because this is not just a small layoff. This is huge. And there's going to be a lot more. Now, Challenger, Gray, and Christmas, they are saying that November, the job cuts in November, is the worst they've seen since 2012. Now, of course, you can't tell this by the unemployment numbers. If you listen to the Fed and you listen to the federal government, they make it seem like, everyone has a job. And what they're saying, no, everyone doesn't have a job. Actually, what they're seeing is that there's been a 30.1% surge year over year of job cuts. And this is the worst they are seeing since 2012. Now, the areas that they're seeing this in is healthcare, consumer products, and services. And they're saying that it's on the rise. Now, we know that this is a problem. We've been looking at the retail industry. They've been cutting jobs. We know corporations, they aren't getting the revenue, the profits that they've been talking about. Yes, they've been putting out their earnings, but you can manipulate that. We know the unemployment numbers are completely fabricated. We know that the restaurant performance index is continually dropping. Traffic is dropping. And we already know at this point that the holiday season isn't going the way the corporate media is making it seem, like the federal government's making it seem, because they're telling us how great Black Friday was. And when we look at the actual foot traffic, it has dropped between 4 and 6% compared to last year. And that means less people are going into the stores and purchasing. Plus, there are more stores that are declaring bankruptcy, shutting down. And of course, they're using online sales to show that everyone is out there shopping. And if you notice that they're not making a really big deal at this point of how great Cyber Monday was. They did a little bit, but if it was so fantastic, they would have been all over this. Now, what we're seeing, since people are losing their jobs, they are resorting to credit cards. And what we're seeing is that consumer credit rose by 6.5% year on year, rising to $3.8 trillion as of October 31st. Now, this number is more than double the rate of increase of the U.S. GDP or wage growth, making it clear just where America's purchasing power comes from. Now, we kind of knew this, that those people who are out there shopping, those people who are surviving, they're using credit cards because many people don't have any money in the savings. Many people don't have jobs. And you have to resort to borrowing money. The same thing goes with student loans. The same thing goes with auto loans. And the non-revolving credit, it has reached a fresh record of $2.79 trillion. And this is pretty darn bad because if we go back in time to 2008, we see that credit card debt is around $1.011 trillion. At the time of the credit bubble, back in 2008, it was at $1.02 trillion. We're almost back to where we were. And if you notice, we've been talking about the everything bubble, which encompasses all these bubbles. And when things go south, all these bubbles are going to pop. We see that student loans and auto loans, well, it shows that they have hit all-time highs. Auto loans are at $1.1 trillion. And we see that student loans are at a record of $1.486 trillion. I mean, if we look at this, the debt has continually gone up because this is the product of the central banks. Now, student loan debt is now as big as the U.S. junk market. I mean, think about this. And the delinquency rates on student loans are continually rising. They're much higher than those on auto loans. Why? Because they've told everyone to go back to college, get an education, take out student loans, and there'll be plenty of jobs. Well, what's happening is a lot of people are coming out of college and they can't find the high-paying jobs. Yes, they get some part-time jobs. They live with their parents. This is why more people are living with their parents, and they have a very difficult time paying off the student loans. This is why the government came up with the idea, okay, we'll take how much you're earning, we'll spread it over a certain period of time, and we'll make the payments much, much lower because they realized that these individuals cannot pay for the student loans. I mean, look at all these different indicators that we've been talking about and how bad it has gotten since 2008. And actually, if you go back in time, it's just continually getting worse and worse and worse as we move forward. And we've been looking at many different indicators showing us that this whole economy is completely and utterly falling apart. Now, Bank of America has this indicator. They have many different indicators, and many of them are showing that we are headed into a recession, a bear market, and there is one indicator which guarantees a bear market. It has been right 100% of the time. It just cannot predict the exact time frame, but it gives you a rough idea. Now, the S&P 500 3-month earning estimate revision ratio, the ERR, which is the earnings estimate revision ratio, fell for the fourth consecutive month to 0.99 from 1.03, indicating that for the first time in 7 months, they were more negative than positive earnings revisions. Now, why is this significant? Why is this important? Well, Bank of America explains this. The 3-month S&P 500 ERR is used by the bank as one of its 19 key bear market signposts. And with the 1-month ERR falling below 1.0 for the second time in 6 months, this marks the trigger for the 11th bear market signpost. Bank of America's ERR rule is triggered when, over a 6-month window, all of the following criteria are met. The 1-month ERR falls from above 1.0 to below 1.0. 2, the 1-month ERR is below 1.0 for 2 or more months. And 3, the 3-month ERR falls below 1.1 for at least 1 month. Now, incidentally, the hit rate of the ERR bear market indicator, meaning its historical accuracy in predicting a bear market, is 100%. The only question is the exact time. And we see that each time this has shown up, we were a couple months away. There was one time it was almost a year. So if we look at this, we can see that we are pretty darn close for something to happen here. Now, of course, one indicator out of 19 is flashing a bear market dead ahead. Does this mean that the other ones show everything is fine? Well, no. It shows that the others, and I think there's 12 of them, that are showing that we're headed towards something big, a recession, a bear market, a collapse. Now, can the central banks continually manipulate? Of course they can. But eventually, like what we've been talking about, they're going to lose control. And we see right now that the real economy, I'm talking about the people's economy, I'm not talking about manipulated numbers, it's accelerating to the downside very, very quickly. The debt levels we have reached equal to or are greater than 2008. The economic indicators are all pointing to the same thing, a recession. We see that the market is completely overvalued. We see that there are more companies that are going to be laying off. We see Challenger Grand Christmas as showing that, yes, November, which should be a very good month for jobs because we're coming into the holiday season, was pretty darn bad. Retail is continually closing. The stores are closing. It's not improving. The GDP numbers are completely made up. And we have pension problems. We have loans due for the retailers that comes due in 2018. I mean, we have a perfect storm headed our way. And the banks and the central banks are scratching their heads. They don't know what to do, so they're not doing anything. And what are they doing? They're going after the crypto market because that is their biggest threat. They're not caring about the economy. They don't want some other currency coming in. They don't want anyone looking at a different currency because they want to maintain control. And as we move forward and as we head into 2018, we're going to see things that we wouldn't even think of. And we're going to see the economy most likely rip itself apart. This is why you need to be ready and prepared, because we can see coming through into 2017 from 2016, when we said the holiday season was going to be awful, there's going to be a lot of stores closing, it all came true. Well, this time around, they're not going to be opening stores. Online sales is just not going to improve. Yes, they're going to manipulate the numbers continuously, but everything else is going to fall apart. More people are going to lose jobs. It's going to get a lot worse. So get prepared. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.